Where are you investing your own money? Are you buying stocks?
I don't buy stocks.
All right, guys, we're going to go through a lot of interesting investing advice today. So let's start with the ancient god of investing.
Let's pretend there is no stock market. Let's say I had to buy these privately, like you buy a farm privately, like you buy an apartment house privately. They're investments. So you're looking to say, what can I do with money I've saved to put it away so I feel good about getting it back later under any circumstances, but not necessarily on a given moment. All I'm trying to do is buy businesses.
This sounds like an extreme simplification, but it's actually all there is to it. Buy a company or an ETF if you know that what you're buying will grow over time and you believe that your money is better parked in that investment than in any other.
So let me show you the power of starting early with investing with this example from Financial Peace University with our friends Jack and Blake. So Jack starts investing at age 21 and invests $2,400 a year for 9 years. Then he stops at 30 years old. So 9 years of investing, total amount contributed $21,600. His friend Blake starts investing at 30, and he invests $2,400 a year till 67. So he invests for 37 years. The total amount he contributes is $91,200. Now they're both at age 67. Jack's investment has grown to over $2.5 million. Blake's investment has grown to almost $1.5 million. So get this, 9 years made a difference of over $1 million. Blake never caught up, even though he invested for a longer period of time. So the earlier that you start, the more time you'll have and the more your money will grow thanks to the power of compound interest.
All right, I did some math here, and assuming that investors invest the money on a monthly basis, George here assumed around 11% return, which is quite optimistic. Still, even if you assume 10 or 9%, the result is the same. The message is clear. Investing early is much more important than how much you invest. Great message. I like George Camel. You should follow him.
Here's a great one. It's $3. How much can I lose? This is a great one. You see, I don't have a computer and I can't do high-level math, but just do this one. Let's say your neighbor buys $10,000 of a stock at 50, and the stock's now 3, and you put $25,000 in at 3. If it goes to 0, who loses the most? A lot of people cannot answer this question, you know.
Peter Lynch is always entertaining to watch. Man, the man is a phenomenon, such a great investor. So remember, the unit price of the stock doesn't matter. It doesn't matter at all. Let's stay on Lynch now for another one.
I'm trying to convince people there is a method. There are reasons for stocks that go up. Coca-Cola, this is very magic. It's a very magic number. Easy to remember. Coca-Cola is earning 30 times per share what they did 32 years ago. The stock has gone up 30-fold. Bethlehem Steel is earning less than they did 30 years ago. The stock is half its price of 30 years ago. Stocks are not lottery tickets.
This is something that everybody forgets. And if you invest in Apple, Microsoft, Tesla, or in whatever growth stock or ETF, just like I do, you make this mistake. Stocks in the long term tend to grow like the earnings. If the PE ratio grows over time, it means that the stock price is growing more than the earnings. And this cannot go on forever. At some point, it must go down.
This is how I would invest $10,000 if I were starting all over again. First, I'd invest $5,000 into an S&P 500 ETF like VOO or SPY. This is going to be the foundation of your portfolio, and it's up 83% in the past 5 years. Second, I'm adding another $3,000 into QQQ. That's the ETF that gives you exposure to the software and tech companies, and in the past 5 years, it's up 135%. Third, I'm going to add $2,000 into a high yield savings account, and that way I always have some cash on hand in case there are any opportunities to buy up any dips. Let me know if you have any questions. I'll also have some free downloads in my profile.
Humphrey is a great guy, really humble and pleasant. In the improbable case that you don't know him, check out his channel and you'll see he has quite a lot of success on YouTube. So kudos to him. I wish him always the best, and he's doing great.
Talk to me about investing. Do I pick stocks or index funds? And I'm like,
bro, you're poor. You're poor. Here's the thing: is when you do the dollar cost average thing, because everyone likes to put it in the Excel sheet, and everyone gets Excel rich. The thing is that by the time you retire with $4 million on that Excel sheet, $4 million will be $1 million today. Just not a lot of money. Now people are like, that is a lot of money. It's not when you're trying to live on it and you got like 30 more years to live. Take the compounding of 4% a year on inflation and do that for 40 years and then see what the money really looks like. And whatever it is, I think it's around 4%. Like people aren't taking the inflation into account.
Totally true. And although in my Excel file, I do take inflation into account, I have to say that Alex Hormoz is a brilliant, inspiring, and incredibly talented entrepreneur. I invest in index funds myself, but obviously with this YouTube channel, I'm trying to create something bigger than what I can achieve with my regular income. So if you believe that you can start a business, that's of course the best way to go.
I went through a huge transformation, I would say, the last 2 years. We had a lot of people on the podcast. Hormozy was one of them. And every person I say, like, hey, what's your advice from me? And these are people who are way more successful than me. So I like hang on to every word they say. A lot of them say, oh, you need to scale up and you need to do this and that and create a business. And I started going down those paths. And I started exploring options of doing more. I said yes to more things. I started tinkering in new endeavors. And honestly, I was miserable. I couldn't stand it. I was the most unhappy the more I tried doing.
Now, I put this video right after the Hormozy one on purpose because even though it's true, like Alex Hormozy says, that starting a business has 1,000,000 times more potential than just saving and investing in ETFs, it's true that it's not for everybody and it doesn't necessarily make you happier. And on top of this, the probability of it working is much lower than what people think. Because in YouTube, you only see the successful ones, but never the ones that fail all their lives. Take me, for example. I started YouTube after listening to Ali Abdaal saying that YouTube is a marathon, and then after like 1 year, he was already earning more than from this doctor job. And here I am, after 3 years of work, making maybe $100 a month with 10,000 subscribers. It doesn't always work for everybody, and the chance that even consistency is not going to take you anywhere is unfortunately high.
Where are you investing your own money? Are you buying stocks?
I don't buy stocks. For the most part, I'm buying businesses more than anything. I mean, there's just not a better trade I can find. For instance, we just bought a business in the defense space. That business is 90% seller financed. It's profitable. We make all our money back in like a year. Where can you do that in stock market investing?
All right, she's a smart girl and she says a lot of interesting stuff, but she's definitely making this sound a lot better than it is. There is no owner in the world, above all in the defense space, willing to sell and finance 90% of a valuable business that can pay for itself in 1 year. If you do have such a profitable business, you sell it for a high multiple on the net earnings and you're not going to sell or finance it. But this video is important because I want to make a point out of it, and that is buying stocks is investing in businesses. In the stock market, you do nothing different than what you do by buying a private business. And the transparency on the multiples used is even higher in the stock market than it is by buying private businesses.
I wouldn't touch a stock. I don't touch mutual funds. I don't touch ETFs. You know why? Because it only makes them rich. If you read Rich Dad Poor Dad, it says your house is not an asset.
All right, this is my take on Kiyosaki. Great entrepreneur, extremely successful in the real estate business, knows nothing about the stock market.
We have one individual in her 20s, another in the 30s, another in the 40s, another in the 50s. And we said each of them is gonna save $10,000 per year for the decade that they represent. They're all gonna invest the exact same amount of money. They're all gonna invest exactly $100,000 for that decade. But when you actually look at what happens, what their terminal portfolio values are worth at retirement, it's amazing. Tia, who started early, who only saved for 10 years from 20 to 29, her $100,000 turned into almost $2.6 million, assuming an 8% rate of return. You compare that to Fanny, though, who waited until her 50s, she ends up with only $237,000. It is a wide contrast between when you get started and how powerful your dollars can be.
If you don't know the Money Guy Show, check their channel. Brian and Bo are entertaining, to the point, competent. They're just great guys. Now, let me move to another great guy, a YouTuber that I follow called Marco that you absolutely need to follow.
In this country, you get taxed for everything. You get taxed for when you fart, okay? Fart tax, sales tax, income tax, property tax, this tax, that tax, death tax, wealth tax, estate tax. It's ridiculous, okay? We used to have revolutions over a 3% raise in tea, okay? Now we're just like, tax me harder, please.
All right, Marco has a really good point here. And I chose this video to send this message. Remember to leverage as much as possible tax advantage accounts. For instance, 401k and Roth IRAs in the US, ISA in the UK, TFSA in Canada, superannuation in Australia. And if you come from European countries like Germany, not only is there almost nothing even close to a good retirement account, but you get even partially taxed on unrealized gains. Hoo-ha!
$1,000 in an emergency fund, which, believe it or not, Dave Ramsey, is not even close to enough money. And many people have come on the show and they did the $1,000 emergency fund and then they ended up in a worse situation than they were before because it's not enough money to cover anything in this world.
It's not.
$1,000 is not enough as emergency fund. I'm sure you know that.
Every young person, especially young men, is under the impression they're smarter than they are and that they can beat the market. So, okay, take 30% of your money, have some fun, buy Starbucks, Nvidia, Unilever, Novo Nordisk, whatever you think you have insight into, so you can learn a life lesson that over over the long term you don't know what you're doing and just put it in an index fund. Because the marvelous thing about the human race is we become more productive, and the Western economies, generally speaking, over the medium and long term are up and to the right.
Scott makes a great point here, and I agree with the fact that he says, if you believe that you're smarter than the average, invest in those companies if you want, and learn the hard way that you're not as competent as you think you are. I think that sometimes we really need to make our own mistakes to truly learn a lesson.
The real money that I made over the years is holding companies for 7, 8, 9 years and keeping them. I've looked back, we bought casinos, and you got to buy them when nobody wants them, really. I mean, that's the real secret. You buy things, it sounds very simple, but it's very hard to do. When everybody hates it, you buy them. And then when everybody wants them, you sell it to them.
Carl Icahn here, guys. Maybe not the most loved investor, but he's totally right. Buy when everybody hates it.
You kind of wonder how the mutual fund industry has held itself together against the onslaught of indexing. And I think the answer to that is in this great bull market, if you had a 10% return, which is roughly what the average fund has given you, you got 40 times your money instead of 60. Well, nobody's looking at the 60. And they're saying any manager that can take my $10,000 and turn it into $40,000 is my friend forever. And he's a genius. And he's actually fallen way short of the market. So one of the lessons is, I think, trees don't grow to the sky.
John Bogle was a legend, wasn't he? Such a great man. I have nothing to add to this. He said it all.
I recently saw some scammer who we both know online promoting 20% returns. It said 20 in huge. I'm like, how's this guy not incarcerated? Anyone who knows the basics of personal finance, in fact, anyone who's watched this interview knows 7% is your good comparison. So if somebody's promising me 20% returns, I already know it's a lie. It cannot be true. It would be like me going, I can promise you that you can run 40 miles an hour if you use my supplement. You're just like, I know this is a lie. It's impossible. Over the course of the long term, it is effectively impossible for 20% returns.
Needless to say, guys, don't trust returns that are too good to be true.
If you do these 5 things, you will win with money 100% of the time. Number 1, you need to have a written plan, a budget. No one accidentally wins. Second thing is you got to get out of debt. Your most powerful wealth building tool is your income. And when you spend your whole freaking life giving your money to banks who fill up the skyline and have furniture nicer than yours, that makes you stupid. Number 3, live on less than you make. And then you're going to save some money. You know how rich people get rich? They save money. And if you'll get out of debt and you'll invest and you live on less than you make and you have a plan, then you can do the last one. It's the most fun you'll ever have with money. You can be outrageously generous.
So I totally agree. 5 great points. Well, I want to clarify one thing. Dave Ramsey says your most powerful wealth building tool is your income. Your income might not be the most powerful one overall, because who makes real money are entrepreneurs, but it's true that for most people, it's the most powerful that they have available.
I had a woman come to see me here not long ago, and she'd come on some money, not very much, but it was a lot to her. And she said, what should I do with it? And I said, well, what do you owe on your credit card? She said, well, I owe X. I said, well, what you should do, I don't know what interest rate she was paying. It was something like 18%. I said, I don't know how to make 18%. If I owed any money at 18%, the first thing I do with any money I had would be to pay it off. It's going to be way better than any investment idea I've got.
Always pay your debts first, guys.
What's the biggest mistake people make, though?
Well, the biggest mistake they make is listening to a lot of other people and buying something because they think it's going to go up next week or next month. You should understand what you buy. Now, if you buy a farm, you look at the farm and you say, I expect to get so many bushels per acre, corn or soybeans, and you figure out how much that'll be worth, and then you figure out what the price should be. In stocks, people, their neighbor whispers something to them, and they run out and spend money that it took them years to earn. So you always want to look at the productive ability of the asset you're buying.
It's crazy how really, with any kind of investment, we tend to be so precise in calculating our future return, except with stocks.
Invest in simple, predictable, free cash flow generative, dominant companies with large barriers to entry that earn high returns on capital, that have limited exposure to extrinsic risk we can't control, strong balance sheets, don't need access to capital to survive, have excellent management, good governance. Sounds logical, but occasionally we've diverged. But in really each case where we've compromised on business quality or complexity, we've been harmed.
Listen to what he said. each case we've compromised on business quality or complexity, we've been harmed.
I've told students if when they got out of school, they got a punch card with 20 punches on it, and that's all the investment decisions they got to make in their entire life, they would get very rich because they would think very hard about each one. And you don't need 20 right decisions to get very rich. 4 or 5 will probably do it over time.
This is a real pearl from the legend. So simple and still so effective. Think really hard about each investment you make and you won't need thousands of good decisions to become wealthy. Now, the last video I want to show you is because I want to remind you what's really important in life. So be nice, subscribe to the channel, guys, to give me some motivation to continue. And after this, let's watch this video together that I watch every time I don't feel realized or successful. So in whatever situation you are, always remember what Warren Buffett says here.
When you get to my age, you will not measure how well you've done by how much money you've got. I can guarantee you that. You'll all do fine on money anyway. I mean, think about it. 7 hours a day, you're in a bed. You got exactly the same mattress I've got. If you don't, we'll sell it to you at the furniture mart. We're on a parity. I can't outdo you, in terms of my sleeping enjoyment. You can match it by buying this mattress, which we'll give you a special price on. Just mention my name. We eat at the same places, We eat at Dairy Queen, particularly if you're in my position because we own it. We travel the same. I mean, I had a 10-year-old car up till about a year ago. But you will measure your success in life by how many, and extent, whether it's the people you want at 70 or whatever the age may be, you'll measure it by how many of them really love you. You can't buy love. You can buy your name on buildings, you can do all kinds of things. But the only way you get to be, love is to be lovable.
That's so true. Thank you guys for watching. See you in the next video.